Patrick Camuso here from Camuso CPA. I recently gave a speech at ETH Denver titled The Compliance Era, How Tax Regulation is Reshaping Web3. And I want to discuss that here today because this is a very important topic as we're moving through this year and even beyond this year. And the core of this talk was focused on the maturity of crypto from a compliance perspective. For the past decade plus, crypto transactions have existed with limited visibility for tax agencies and regulators. Taxpayers were self-reporting their transactions, and there was limited visibility overall into the transactions that the taxpayers were reporting. And as a result of this, there was a very high degree of non-compliance. And, there still is a fairly large degree of non-compliance. And as we start to see Web3 and the digital asset market mature, this becomes unsustainable. And what we're seeing now with the rollout of Form 1099-DA and with other considerations that I'll get into here, we're starting to see the integration of digital assets and cryptocurrency into the existing tax systems and compliance systems. So we're seeing this here in the US with Form 1099-DA, but this isn't isolated. It's part of a broader trend across stablecoin legislation, global coordination through CARF, and a wave of tax proposals that are really going to shape how Web3 operates. So, this is what I want to discuss here today. And this video is going to be hitting on points that, again, are pertinent to investors, to founders, even to practitioners, because this Form 1099-DA impacts everybody. So very briefly, digital assets are taxed as property, and that has serious implications to everybody that's transacting, because every time you purchase a digital asset, it requires that you calculate and track the basis for that purchase. And when you dispose or sell an asset, this requires that you calculate the accurate proceeds and then assign the right basis to that sale in order to calculate an accurate gain or loss. Now, why is this so difficult in crypto? There's no standardized reporting that existed before Form 1099-DA, which we'll get to here in a moment. And blockchains don't record the relevant tax data that you need in order to report your transactions properly, even though they're immutable public ledgers. So what this leads to is the need for taxpayers to do their own accounting and do their own cost basis calculations, because this is not being done automatically for them. So that's the environment we've been operating in, and that environment is now changing. And again, it's going to have a deep impact on investors, builders, founders, even practitioners that are going to have to assist these investors and businesses from a compliance perspective. So this is the end of the self-reporting era for digital assets. For a decade plus, there was no visibility into these transactions. And now this is going to be the first year for the 2025 tax filing year, which we're filing right now in 2026, where the IRS is getting this broker reported information. So let me explain what 1099-DA actually does. It is a form that brokers are receiving, or that brokers are sending to the IRS. For 2025, the IRS is going to be reporting proceeds data to the brokers, and they're not going to be reporting cost basis data. In future years, they're also going to be reporting cost basis data for covered assets in addition to reporting proceeds data. So this is a big shift. This is the first time that the IRS is going to be able to compare what a taxpayer is to independent information that has not been submitted by the taxpayer. And what this is going to lead to for taxpayers that are not filing completely accurately, or even for some taxpayers that may be filing accurate but aren't reconciling these forms, is that there's going to be compliance issues. If your return doesn't reconcile with what your broker reported, this will be flagged through automated matching systems that exist at the IRS, and they'll be able to flag these discrepancies in a much more systematic way at scale. With this third-party reporting data, than they've been able to in the past when it's just taxpayer self-reported data. So, this is the first year that the IRS is going to be able to compare what a taxpayer is filing to an independent data set. And that's where all the friction is going to come into play. So let's get into that a little bit. Why is crypto reporting so difficult? Why can't we just blindly take these 1099-Ds and file them? And why has it gotten to this point where it's such a challenge? There's really 4 layers to tax reporting your crypto. The first layer being the transaction records, the on-chain data, the exchange records. And this data is not standardized. This data has to be normalized, categorized, and reconciled. And in order to do that, you're going to leverage one of the many softwares that are out there that assist with calculating your cost basis and your gains or losses and your whole entire cryptocurrency portfolio. The difficulty with the tax softwares is that they have to deal with the non-standardized data that is persistent across all of these transactions across wallets and exchanges. And they also have to apply tax categorizations to each of these transactions. And when you start analyzing the various tax softwares that are out there, which are needed, there are divergent outputs for the same activity. So that means that there is a large risk for taxpayers if they're not properly categorizing and reconciling and doing due diligence on these calculations that are in the softwares. After you're done with your software layer, you have to actually file your return. And in order to file your return, you need to make sure that you've calculated correctly with the correct disclosures, documentation, methodology, and so on. So you have to make sure that what you're reporting on your return is reflecting both what your calculations support and what actually took place on chain and within exchanges. And now what we have is Form 1099-DA. That's going to be sending partial information based off of the data that the broker has for that your activity to the IRS. And you're now going to have to reconcile your on-chain and exchange records, your tax software calculations, and what you're reporting on your return to Form 1099-DA. So all 4 of these information sources or reconciliation steps are not designed to reconcile together, and there can be discrepancies between these. And to the degree that these discrepancies are material, they can create compliance issues for taxpayers. Now, as we're moving into this third-party reporting regime, this will be further complicated by some implementation challenges that are sort of, built into the structure of the market and tax reporting right now. So, the first one being the coverage gaps that exist. Right now, Form 1099-DA only covers custodial environments. So your exchanges, for instance, will be reporting, but a transaction that takes place in a non-custodial wallet across a decentralized exchange will not be reported. But taxpayers are still responsible for reporting this activity. So it's not only imperative that taxpayers do their self-accounting, reconcile it with 1099-DAs and report that, but they also need to be aware that, part of what they're accounting for will be reflected on their 1099-DAs. But if they have transactions that are taking place in non-custodial environments across DEXs, then that's not going to be reported on a 1099-DA, and it still has to be reported for tax purposes. So, this is a year where there's a real risk that a taxpayer can underreport and overreport their taxes in the same year when it comes to digital assets. And how would that happen? Well, they, in a scenario where you get a 1099-DA and it's not reporting your basis and you blindly report that 1099-DA for tax purposes, that would lead to you overstating your gains most likely because your basis and holding period aren't considered. And then similarly, if you're just blindly reporting this 1099-DA and you're not reporting your DEX activity because you're thinking to yourself, it's not on there, or maybe it's in there, I don't see how it's calculated, then that would be underreporting that activity. So, it's very important to understand these coverage gaps and how they reconcile or don't reconcile to the 1099-DAs. Additionally, there's basis fragmentation. So as of 2025, we're on wallet by wallet, account by account cost basis tracking, which is different from previous years where you were able to do this all on a universal basis. I've done separate videos on that. I encourage you to check that out. But this is important because even if you purchase an asset on a centralized exchange, if you transfer that to a non-custodial wallet and then maybe transfer it back to that centralized exchange or to a different one, you're going to be breaking the chain of custody. And that exchange is not going to have visibility into what the basis and holding period of that asset is once it leaves their custodial environment. So, this makes basis tracking much more difficult for taxpayers, and it places a larger reconciliation burden on them to the degree that they're using non-custodial wallets, because anytime you move from custodial to non-custodial, you are going to have to be tracking that basis because it's not going to get picked up on the 1099 DAs. So, those are two of the friction points. The third one are methodological differences and divergences across the tax characterization of different types of transactions. And I don't want to get into all the types of transactions because, there's many of these when it comes to digital assets. Bridges, wrapping assets, prediction markets, how are those taxed, so on and so forth. We don't need to belabor it too much, but there are divergences between the tax treatment to different transactions between taxpayers. And this tax treatment of all these transactions impacts basis calculations. And basis calculations are going to be increasingly scrutinized with Form 1099-DA, as you can see, due to all the factors here. So to the degree that there's not a universal standard or guidance related to, the categorization of a certain type of transaction, there's going to be divergence. And if you don't take the right position, this can cascade through your basis calculations and create compliance issues for you. So one other important thing to point out is that the 1099-DA is US focused, but this trend extends outside of the United States. This is an international trend, and we see this with CARF, the Crypto Asset Reporting Framework, which is a cross-jurisdiction crypto reporting framework that's being adopted by many countries. And again, we'll do separate videos on this. Details are outside the scope of this conversation. But the big takeaway here is that this transaction visibility is worldwide, and countries are not only getting that visibility within their tax jurisdiction, but they're sharing them between tax jurisdictions. So the assumption needs to be that your transactions are visible across the world to all tax agencies. And, this is going to become increasingly true as we see CARF get implemented. So what does this mean for investors and founders? Your transactions are going to increasingly be sitting in these environments where there's going to be third-party reporting and visibility by tax agencies. And, one of the biggest challenges is that the DA is not going to reflect your full activity or be a complete calculation to file your return. So getting out ahead of this, most investors and founders that I see are behind on their portfolio calculations. They're not in compliance with Revenue Procedure 2024-28. And they're just not in really any position to be even taking the first steps to reporting their taxes accurately and getting in compliance with reconciling their self-calculations with the 1099-DAs. So really getting out ahead of this and doing your historical accounting, doing your cost basis reconstructions, making sure that the methodologies and the tax categorizations that you've applied to your transactions are accurate and also well documented. So you're able to support your calculations if there are discrepancies that need to be reconciled related to third-party reporting. For builders, tax implications of your protocol design have always impacted your users. But as we start to see Form 1099 DA get rolled out and the industry start to feel some of this compliance burden, users are going to become much more aware of this and sensitive to this. And to the degree that, you have ambiguous tax events or it's hard to track the transactions from a compliance perspective. This is going to start to impose real compliance costs on your users. It already does, but they're going to become much more sensitive to it, I believe. So to the degree that you're able to build compliance into your protocol design and create predictable transaction designs that are better to deal with from a compliance and tax perspective, this will become increasingly a competitive advantage. And, from some of my conversations at Denver confirm this, because serious builders are starting to understand this and are starting to think like this. And, I've had many conversations along these lines. And, what does this mean for practitioners, for CPAs, for tax preparers that are going to be getting these tax forms? The 1099 DAs are not going to be complete. They're not going to be accurate. And your clients are going to need analysis and accounting complete in order to be able to file these accurately. And as a practitioner, you're not going to be able to blindly rely on the 1099 DAs or self-reported accounting from taxpayers without doing deep due diligence on it. So you need to be preparing your firm for this, to either be able to start to implement a strong digital asset accounting practice into your firm, or to set up a partnership or referral arrangement with a specialist firm like Camuso CPA that can assist your clients with these cryptocurrency calculations and 1099 DA reconciliations, so you can accurately and confidently report their returns. And we do this with a lot of firms. So if that's something you need assistance with, we can assist with that at Camuso CPA. So, there's a bigger picture to the compliance era. Form 1099 DAs are one step forward. Other layers to this are the policy layer. There is a lot of attention on digital assets, and there's many different debates and proposals right now from a policy perspective when it comes to many different questions with tax characterization, and really how this market's going to look for the next decade plus. So think staking income taxation, wrapping transactions, wash sale rules, and this will go on and on. We're going to see new asset types emerge where there's no authoritative guidance yet, that we're going to need to get future guidance on, like prediction market contracts, tokenized real world assets. So, this is going to be an ongoing developing area, and the outcomes of these legislative and regulatory questions to a large degree will determine the structural boundaries of this market for the next decade plus. And builders and investors that can engage in these conversations are going to be better positioned than those who do not. And the other layer to this is on-chain reporting, because right now these 1099 DAs are only covering centralized exchanges. And the fact that it's only covering centralized exchanges really, is unlikely to be the endpoint. It's more of a starting point. There's going to be a lot of friction for taxpayers and for tax agencies related to the partial coverage and all of the reconciliation issues between, what's reported on a 1099 DA and what's not reported on a 1099 DA, because it's a non-custodial environments. These problems are going to accumulate and scale. And as they do, it's going to build more pressure towards integrated solutions. And the logical direction of that is on-chain reporting infrastructure, where the tax relevant data is captured at the transaction level, at the protocol level, on chain, and potentially either directly or through intermediaries transmitted to tax authorities without requiring the whole step of having only this reported for centralized exchanges via a broker via Form 1099 DA. So this is going to also raise serious questions and debates about identity, privacy, how far decentralized systems should accommodate its compliance requirements. And these debates are going to largely shape the industry as these develop and get implemented as we move forward here. So, here's the bottom line. Digital assets are just two large and interconnected now with global financial infrastructure. We are being integrated into the tax systems worldwide because these transactions on the blockchain are not going to remain in a compliance gray zone as we move forward here and the market becomes more mature. And, I saw this market maturity to a certain degree this year at ETH Denver. There were fewer tours, there was more conviction, more serious builders, more suits and compliance professionals there. So, we're able to see this, that the industry is maturing. And this compliance era is going to reshape protocol design. It's going to reshape user behavior, capital flows, and regulatory legitimacy in ways that are beginning to be felt, but are going to get felt at a much larger degree in the builders and founders and investors that can understand this transition and how to protect their portfolios and how to design their protocols and how to, what documentation do they need to protect their bottom lines, and how can we start engaging with policy and regulators to start shaping these processes. These are going to be the ones that are positioned for what comes next and positioned to thrive for the next decade in this industry. So this is the digital asset. It's the next step of cryptocurrency and digital assets and Web3 maturing. And it's very important for investors, founders, and builders, and even other tax professionals to get out ahead of this. And that's what we assist with at Camuso CPA, whether it's providing cryptocurrency accounting services, 1099-DA reconciliation services, tax planning services. We can assist with this, whether you're a investor, founder, builder, or if you're even a CPA firm or tax practitioner that doesn't have a native crypto practice and needs to partner with the firm to assist with this. So I'll leave some links below that'll link to the full article related to the ETH Denver speech, as well as some of our guides on the 1099-DA. And if you do need assistance with anything that we've discussed here from an accounting or tax perspective on chain, feel free to reach out to me and my team at camusocpa.com.